In this part, we're going to be showing how the stockholders' equity is going to be presented on the balance sheet. There are two methods that may be used to report the stockholders' equity. The first method is each class of stock is reported, followed by its related paid-in capital accounts. Retained earnings is reported, followed by a deduction for treasury stock. The other method, the stock accounts are reported, followed by the paid-in capital reported as a single item. So we combine all the paid-in capital of different categories in one single item, which we call it additional paid-in capital. Then the retained earnings is then reported, followed by a deduction for treasury stock. So here, this is like a comparison of the two methods. You can see on the top example of the stockholders' equity section, we have the preferred stock, and then we have excess of issue price over par, and then we have the total value for the paid-in capital of preferred stock. And then we have common stock, and then we have these, like all the details related to it, and then we have the excess of issue price over par, and then we have the value of the common stock. And then we subtract from the common stock the treasury stock, and we get the total paid-in capital for the preferred stock and the common stock. And then we add the retained earnings, and then we subtract the treasury stock at the very end. This line here that says from sale of treasury stock, that's the additional paid-in capital that's related to the treasury stock. And then that's a line of treasury stock that's based on cost that gets deducted from the total equity. So that would give you the total stockholders' equity. I personally prefer method 2 because it simplifies the process. So we have the preferred stock, common stock, each has its separate line on one line, and then we combine all the paid-in capital or all the paid-in capital in excess of par for either preferred stock, common stock, or the treasury stock in only one line here, one category, and we add these three lines and we get the total contributed capital. Then we add the retained earnings and we subtract the treasury stock to get the stockholders' equity. So whether we use method 1 or method 2, the end or the bottom line value has to be the same, which is 1.525 or 1,525,000. Same thing here. So it doesn't make any difference whether we go with method 1 versus method 2 when it comes to values. It's not like two depreciation methods or two inventory costing methods. No, it's just different ways of presenting the stockholders' equity. So significant changes in stockholders' equity during a period may also be presented in a statement of stockholders' equity or in the notes to the financial statements. So how about reporting retained earnings? Changes in retained earnings may be reported using one of the following. It could be separate retained earnings statement, which again, this is something that we've seen before, or which is the statement of retained earnings, or what we call it, retained earnings statement. Or it could be combined income and retained earnings statement together. Or we could have something called the statement of stockholders' equity. And at this level, I don't really like to stress on it too much. So when a separate retained earnings statement is prepared, the beginning balance of retained earnings is reported. The net income is then added, or net loss would be subtracted, and any dividends are subtracted to arrive at the ending retained earnings for the period. So this is the statement of retained earnings that we've seen before. We see here the beginning balance of retained earnings. We have the net income added, then we subtract the dividends, and these are the two types of dividends that we have, preferred stock and common stock. We combine them together, so the 10,065 is 75, and then we subtract it from the net income to get the amount of change in retained earnings. And here in this case, the change is a positive change, so we add it to the beginning balance to get the ending balance. Very straightforward. Basically, you can simplify it into 4 lines. Beginning retained earnings plus net income minus dividends to get the ending balance of retained earnings. There's also something that we need to know called restrictions, which is related also to retained earnings. So the use of retained earnings for payments of dividends may be restricted by action of a corporation's board of directors. The board of directors might say, oh, we have positive retained earnings, but we're going to restrict it for other use. So such restrictions, sometimes called appropriations, remain part of the retained earnings. These restrictions are usually disclosed in the notes to the financial statements. So restrictions of retained earnings are classified as either legal, contractual, or discretionary. So if it's legal, like things like state laws may require restriction of retained earnings. For example, states might restrict retained earnings by the amount of treasury stock purchased. In this way, legal capital cannot be used for dividends. Another reason for restrictions of retained earnings could be contractual or like based on an agreement. So a corporation may either enter into contracts that require restrictions of retained earnings. For example, a bank loan may restrict retained earnings so that money for repaying the loan cannot be used for dividends. And then it could be discretionary. So in this case, a corporation board of directors may restrict retained earnings voluntarily. So it's by choice. They just want to keep some kind of reserve in retained earnings. So the board may restrict retained earnings and therefore limit dividends restrictions so that more money is available for expanding the business. Another thing that's related to equity is prior period adjustments, or it's more related actually to retained earnings. So sometimes we make mistakes in the previous year. When we discover it later on, we really cannot go back and adjust the prior year financial statements. So what we do is that we only update the retained earnings account. So the effective errors that may arise from a mathematical mistake or from a mistake in applying accounting principles that are not discovered within the same period in which they occur should not affect the current period's net income. Instead, the correction of the error, called a prior period adjustment, is reported in the retained earnings statement as an adjustment to the beginning balance of retained earnings. This is the part that I'm not going to stress too much on. It's about the statement of stockholders' equity. Simply when the only change to stockholders' equity is due to net income or net loss and dividends, a retained earnings statement is sufficient. However, when a corporation also has changes in stock and paid-in capital accounts, a statement of stockholders' equity is normally prepared. So a statement of stockholders' equity is normally prepared in a columnar format. So each column is a major stockholders' equity classification. Changes in each classification are then described in the left-hand column. So this is how it looks like. We have a column for preferred stock, column for common stock, additional paid-in capital, retained earnings, treasury stock, and the totals. And then we have the beginning balance and the ending balance and the things that would change each one of these balances, starting with net income, the dividends paid either for preferred stock or common stock, the issuance of additional common stock, or the purchase of treasury stock. Again, for exam purposes, I'm not going to focus too much on that because I'm not going to test you on this. I think this is something that would be more related to upper level accounting classes. So this is how the stockholders' equity would look like on a balance sheet for Morning Joe. And as you can tell from the way it's presented here, they used method 1 because we have the preferred stock and its related excessive issue price over par. Same thing for common stock with its issue excessive issue price over par. And then we have the paid-in capital for the common stock, and then we have the total paid-in capital calculated here. Then we have the retained earnings. Then we have the treasury stock subtracted. And this is an example for retained earnings statement. So we have the beginning balance plus the net income minus the dividends to get the ending balance. And then that's another example for statement of stockholders' equity, which again, I'm not going to stress too much on. One last thing for this chapter is an important ratio called earnings per share or earnings per common share. It's very well known for everybody as the EPS or the earnings per share. And it's the earnings per share of common stock outstanding during a period. And it just shows how much earnings has been allocated per stock or per common stock outstanding. So corporations whose stock is traded in a public market must report earnings per common share on their income statement. All these publicly traded companies, they usually on the face of the income statement, they have to report the earnings per share. And the calculation for it is very simple. You get the net income, you subtract the amount of preferred dividends that has been declared and paid to the preferred stockholders, and then you divide whatever you get by the average number of common shares outstanding. The word average means beginning plus ending divided by 2. The beginning is usually the ending of last year. So let's see an example here. Assume the following data in thousands, except for the share amounts, were taken from recent financial statements of Google. And of course, we all know Google. We use it every day. So net income in the recent year was $14,444 million, and the prior year was $12,920 million. And the average number of common shares outstanding, here we have the numbers. If you do the math, the earnings per share was in the prior year 19.41. In the recent year has been getting better, 21.37. So you can see it's a very simple calculation, but it's very useful for investors, and it's very important for them to make a decision related to investment. So by that I conclude chapter 12. I wish you all best of luck, and I'll see you in the next chapter.